Ouch. The AI rally is going to run out of gas, or basically, NVIDIA stock is going to crash. And the last time this pattern happened, we did get a correction. So we will come back and listen to the soundbite from Chris Ailman. But the reason why this matters is because he manages $337 billion. What he says kind of matters. And in a survey, 36% of people think that after the big run for the S&P and the NASDAQ, we have to drop by 5% or more by autumn. That's really interesting. And we'll look at a chart in a moment, which illustrates exactly what that means. But basically, we have a tale of two markets where we don't see a lot of the stuff happening at the surface, but underneath, man, these losses are getting big. Negative 38 for the average NASDAQ stock. And the elves, or basically Wall Street analysts, think that we're going to close the year out basically where we are right now at 54.50. And this is after we've had a solid run or a record count of S&P records in the first half of the year, which have only been exceeded once in the last 100 years. But it's been an uneven rally, which means that equal weight, or RSP, is underperforming by the biggest amount going back to the 1990s. So what this really means is that in an election year, we're kind of stretched here, and people are thinking that we're due for some mean reversion, maybe especially after the debate we saw very recently. So what this really means is that maybe we're going to start to fill some gaps. If we're going to go down by 5%, maybe we fill the second gap here, or maybe even the third, which would get us awfully close to a correction or negative 10%. So now let's listen to this clip here from Chris Ailman and see exactly what he has to say.
So let's start with those elves, because you've been a fan of the elves for a good long time. You worked on getting us to reintroduce them here, figure out how to do it. Right now, if you listen to the Bloomberg elves, they say basically you can put your pencil down and go home for the rest of the year. We're just going to be flat for the rest of the year. Does that make sense?
You know, David, I think it does. This is a good example of summer doldrums, sell in May and go away. I really think people should pay attention to these elves. I mean, it is a bit different than back with Louis Rukeyser, but they were very predictive and powerful. And the fact that they're saying that this is where the market may be at the end of the year, look at the French election. Look how non-US and particularly Europe has sold off in anticipation of that election. I think we're going to see a lot of volatility in the fall and concern about how this election goes. Last night I had nightmares. That was not a good feeling after that. So I just think the market is really capped out in here, and probably it may hit another high right away, but it's going to be trading sideways for a while.
So go below the top.
So there's a lot more to the interview where we don't hear the soundbite about the AI running out of gas, but I just want to be a little bit mindful of time and keep the video shorter today. So what I basically heard him say was that we don't want to be very excited about the rest of the year. But please remember, at the beginning of the year, or even going back to last year, no one predicted things correctly. Everyone thought we were going to get a big crash this year, and obviously that did not happen. I think what's happening here is that he's not beating the market like most asset managers aren't. So what is he saying? Hey, I'm underperforming, but it's not my fault. The market is overpriced. It's not going to go higher, right? That doesn't look like a happy guy to me. He's having nightmares. All right, so let's continue the story here. So if now we pick up where we were, what does that basically mean? Well, here's an analyst's note. He says that the bull market is likely to continue through 2025 and 2026, but this melt-up might be setting up the stage for a meltdown. That's basically what we showed you here, where maybe we're going to get that correction down to fill some of these lower gaps, and that would be almost a correction like we talked about. Negative 10 is actually a correction. So we could flash crash and start to fill these gaps. That could definitely happen. And if so, we're looking for a rapid correction, not a bear market. So that would be a dip and then probably a rip. Why? We're not expecting a recession. The Fed put is back now that inflation is back to target, and the Fed is likely going to ease if markets start to fear a recession. And this really matters because going back to May, when everyone was worried, we saw conflicting economic data that spurred big swings across asset classes. People needed the market to get its story straight. And that's what we're trying to find out right now. Jerome Powell is going to be speaking on Tuesday morning at 9:30. And what's he going to have to say? Well, I think it really matters. So at 9:30 a.m. on Monday, Jerome Powell is going to speak. Then on Wednesday, the next day, we get the FOMC meeting minutes. Remember, they did not pause last time. So I want to hear what Jerome Powell has to say. He's going to be discussing central banking in 2024, which is a very good topic because if we look at the common man CPI, This is how people feel about the economy. It's why Joe Biden's not very popular, even though the economy is quite strong. It's because things cost more than what you're being paid. If things go up by 121, but you only get paid 115 more, well, we don't feel rich. But remember, the Fed doesn't care how you feel. They care about core PCE. That is their preferred inflation gauge. And we finally saw the first tick down, or the biggest decline, going back to last year. So for a 0.2 decline, I want to see what Jerome Powell has to say. That's a really good number for him. At the same time, GDP is still above 2, or again, above potential is what they would call that. And it's important because people are now even talking about going at the next meeting, which would be July. So the pressure's on. Mohamed El-Erian is saying they should tee one up for July, right? July cut. All right. And then Jeremy Siegel here is saying that they should cut rates at the next meeting, which means July. I'm not sure they will, but that's the discussion right now. I think they're going to wait until September, which means they're going to support it with an SEP. But hey, we could be surprised. This is going all the way back to May as well, May 4th. And here it says that it's a Goldilocks report that will please the Fed and the markets. Well, that's Mohammed said. Look where we are. We're at all-time highs. And all this data looks really good. Notably, I think I forgot to show one data point here, going back to the numbers we get on Friday. Why? Well, because unemployment's at 4%. So unemployment at 4, we have inflation coming down, at least according to what the Fed likes, core PCE. We have strong economy. Well, that kind of seems like a Goldilocks scenario. And we might even see Jerome crack a smile, right? That's the biggest smile we normally get from him. So this is going to be interesting to hear him speak. And right now, the market is pricing in a cut for September. So let's see what's going to happen. There's other concerns, though, too. This is from Dawson, and she basically says that bellwethers like crypto are starting to soften. I would agree. We're seeing stretched valuations, and we're not really seeing very much rotation. Breadth is remaining lackluster. If you look to the heat map for the last 3 months or the last quarter, I would agree. Lots of blocks are red. There's common themes here other than the mega caps. And in the last month, things definitely look a lot better. We have to see more of this. Otherwise, we're not going to really go higher, and we're likely looking for one of the dips, which normally happen 3 times per year. And again, that might start filling some major gaps. But remember, the stock market is a device for transferring money from the impatient to the patient. So what that really means is that whether it's July or whether it's later, if it's the 1995 soft landing, look, if they cut in July, like Mohammed's saying, like Jeremy Siegel is saying, well, then they could wait 3 meetings and cut again in December. That would be 1995. Great. And Jerome Powell might be laughing all the way to the bank. So if it's 1995 and not these nasty crashes like everyone's talking about, maybe we can pull off the soft landing where we cut a couple of times, we go sideways, we go dramatically higher, like 220%. And that's really what I'm going to talk about in tomorrow's video. So with that said, thank you so much for tuning in. I look forward to seeing you on the next one.